Like, what are we supposed to do over the next 10 days?
I mean, that's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility, so they want to throw in the towel. But we also know that markets will bottom or have historically bottomed before the event actually happens. You know, the best example is 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? Put that on top of what we've already heard. Are you concerned about where the economy is going?
I mean, it's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. You know, CEO confidence has fallen, and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
Temporary financial analyst and Bitcoin bull Tom Lee discusses the current market dynamics and its impact on Bitcoin. He recently shared his insights on the economic uncertainty driven by tariffs and recession fears, which have been fueling market volatility. Lee believes that a significant market rally is imminent, and Bitcoin stands to benefit from it. Recently, Bitcoin has been trading more like a risk asset, meaning that if the market recovers, Bitcoin is likely to surge as well. However, the key issue is uncertainty. If the market remains stagnant, Bitcoin could face short-term pressure. Currently, Bitcoin is priced just over $84,100, still down nearly 15% in the last month. Lee notes that markets typically bottom out before major events resolve, which could mean a sharp recovery in the coming days. Ultimately, Bitcoin's next major movement hinges on how the market unfolds. Let's dive into Tom Lee's latest interview, where he shares his market predictions for the near future. Before we continue with the rest of the video, do check out Daily 5-Minute Crypto Newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Part of the uncertainty of all of this has been the, iron fist, maybe olive branch. Back to the iron fist. What do you make of it?
Well, I think markets should interpret it positively because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses, and I think it would set the stage for a much bigger recovery rally than we expect. When the S&P had a 10% drawdown, that's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the market
weakness.
the real economy?
I think it's these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence. Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. One of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again. I think markets were positively surprised by the Fed's move, in part because recent staff papers from the Fed had argued tariffs would actually be multi-year inflationary effects. So Fed Chair Powell's comments yesterday, I think, did catch a lot of folks by surprise, just because it is a view that markets probably want to hear, that they'd like to hear that the Fed is viewing tariffs as possibly transitory, because that puts them in a position to actually intervene if labor markets start to weaken. And in fact, that's evident in the SEP, because 90% of Fed staffers now see not only risk to growth, the GDP growth forecast, but it was 90% seeing it as downside risk. I think that the sort of the big elephant in the room has been the absolute fear that has become systematic in markets around April 2nd and the tariff deadlines. And I think that there have been little hints this week that instead of April 2nd being the date of some sort of annihilation of trade relationships, that we may start to see either deals before then or even delays in implementation. And I think that really investors are going to breathe a sigh of relief because, as you can tell, pessimism has become very pervasive because of the fears of what will happen on April 2. So I think that's a positive. And then the other is, and it's really a technical perspective, but Mark Newton, our head of technical strategy, has pointed out there are increasing signs of that we've actually established a tradable bottom. And that's not only the fact that we declined so quickly, but it's that market breadth has really been expanding and then actually following through in a way that looks like this is not a 10% decline that's leading to a 20%, but a 10% waterfall decline / heart attack for stocks driven by rage selling, and now it's tradable. I'd say that probably the final thing that I've seen is, and this is really from our meeting with clients, is that we know there's actually quite a lot of dry powder. Many of our clients have raised a lot of cash. I mean, it's also evident in a lot of the money market balances or prime brokerage de-risking that's taken place. And it's at a time when investor sentiment has moved far more than is justified by the market moves. Whether you look at AAII or Investors Intelligence, both have registered recession-like readings and sentiment. And so it really creates the room for positive surprise. And that, again, I think it'll, like what you just said, if tariff headlines aren't as bearish and if there's all this last-minute work on negotiating something, and yesterday there was a tweet about how into the night Hassett and Lutnick and Bessent were, working on a trade deal. That got so little notice. I think it just tells me markets could be positively surprised.
With unwavering enthusiasm for the Bitcoin space, Lee confidently predicts that explosive growth is on the horizon, fueled by BlackRock and other crypto giants. He assures that the long-awaited surge is imminent as we approach the second quarter of 2025. Now, let's hear Tom Lee discuss the implications of the Fed's rate cuts and the current risks facing the market.
Tom, what usually happens when the Fed cuts and there's a no landing scenario or a soft landing? What are we looking at here?
Yes, this table shows you how progressively over time, when a Fed cuts and there is no recession, it is hugely positive for the equity market, because when you get to 3 months out, the 7 of 7 times when the cutting cycle starts, stocks have never been lower. And 6 months out, never been lower. And 12 months out, never been lower, with a median gain of 16%, which is better than a typical 12-month return for stock. So the key is whether or not...
just for the listener, these instances, January of 71, October, am I in the right column?
Yes.
The Fed cut and we don't have a recession. This is what happens. So those examples, January 71, October 84, October 87, June 89, July 95, September 98, that one I remember, July 19, that one I remember too. So in these instances, if you're not going to have a recession and you have the Fed cutting over the next 3 to 6 months, it's 100% historical win ratio for stocks.
Yeah.
That's really powerful.
That's right. And it kind of defies how, as you know, a lot of skeptics said, oh, the Fed has never had a soft landing ever, but there's been many instances of no landing. So I think it's almost...
Do people say that? Never had a soft landing?
Yeah, there's still...
I guess I've heard.
Well, how many times has inflation been above 9%? Twice?
Yeah.
Once?
Yeah, that's right.
In World War II, right, come on. So what are we doing here? We're talking a lot about the perfect macro backdrop. Stocks are breaking out. Everything is kumbaya. What do you think are some of the, what are the biggest risks that we should perhaps pay attention to?
Well, we surveyed our clients yesterday, like 1,200 responses, and the top concern is geopolitical. So
come on, it's always that.
Yeah, and it's hard to actually make an investment action on this unless it's World War III, right? And the second is the elections, and this is like something where it's like a little bit how you want to position around it, but most people can't have conviction about what they do until they know who's in the White House, even though it shouldn't matter.
Professionals or regular people?
It's the in-between. So let's say it's a family office.
Okay.
Where they as you know, family offices, let's say as a cohort, probably were more cautious the last 2 years. So now see the Fed cutting and they want to actually invest, but they want to time it so they have to make the second decision to get back in. And so I think they want to wait till after the election.
I see they're playing it like Buffett.
No, but you raise a good point.
It's a long-term, short-term.
A family office is a lot of money, but very often answerable to one or two family members.
Yeah.
And it's not like if you piss off that client, all right, it sucks, I'll just deal with my other clients. You only have one client. And if you have a client where they'll be mad, if you get really aggressive in front of the election and then there's an election-related sell-off, you're just not going to risk it.
Yeah. And they want to preserve capital.
You'd rather buy higher.
That's right. They want to preserve capital. And also, then they're also glomming onto the idea, well, EM, especially China, has lagged and they don't mind being late, or they might even be involved there because it's not election sensitive, right?
Tom Lee challenges traditional economic metrics, arguing that they are often manipulated to create specific narratives, such as with labor statistics and inflation figures. The increasing adoption of Bitcoin by governments, institutions, and media highlights its growing recognition and value. However, Lee emphasizes that this is just the beginning, comparing the early years of Bitcoin to the current surge of widespread interest and investment, especially with Bitcoin ETFs now in the spotlight. He points out that these metrics are selectively measured to produce desired effects rather than accurately reflecting the state of the economy, positioning Bitcoin as an alternative free from these manipulations. Lee also notes that major corporations like Apple, Amazon, and Google will use their established relationships to quickly amass substantial amounts of Bitcoin through spot ETFs, bypassing the lengthy processes of acquiring the actual asset. This highlights the transformative potential of cryptocurrencies in traditional finance. Michael Saylor stresses the importance of embracing digital currencies as the economic landscape evolves and urges investors to leverage Bitcoin's potential for a more prosperous financial future. What are your thoughts on Tom Lee's latest interview? How do you think Bitcoin's path in the coming months will affect the crypto market and the broader world of investing?